Welcome back to the Physician Finance Academy series on basic financial literacy for physicians. Today we're going to talk about how we protect all the hard work that we put in over the last decade or longer, getting to a position of being a high income earner. The last thing you want to have happen is to see it all go down the drain because of an accident, a health problem, or some other issue that you can't really predict but could easily have protected yourself from. Yes, today's discussion is a lot about insurance. I know, everyone's favorite. Insurance is one of those things that's painful to pay for when everything's going great, but we're sure glad we had it if things go south. We're going to breeze through these next two slides from here on out in this lecture series. Unless this is your first video with us, you've heard me talk about True Wealth a lot during previous lectures, and I'd encourage you to go back and watch those again to understand what it is we were shooting for. And this is where we are in our list of milestones. Protect your assets. Unfortunately, life is full of ups and downs and twists and turns. None of us can read the future or can know ahead of time when we might face one of these major hurdles. When they happen, we have to deal with it the best way that we can. The last thing that we want is to add to the stress with a major loss of income, a huge expense, or a liability claim against us that could devastate our finances. That just makes everything worse. Although we can't always avoid the challenges that are headed our way, we can at least try to protect ourselves financially against them. So what are some of the things that I'm talking about? Well, there are too many to count, but these are common ones that many of us might face. A prolonged illness or a disability of you or a family member, an accident, theft, natural disaster, death, being sued. We can't protect ourselves against every possibility, but for most of the things on this list, you can buy insurance to lessen the impact, at least the financial one. Okay, so in managing risk, there are really four different pathways to consider: risk avoidance, risk reduction, risk transfer, and risk retention. Risk avoidance is fairly self-explanatory. You avoid the activity that is adding unnecessary risk. Let's use rock climbing as an example. One strategy to avoid a serious injury while rock climbing is to not rock climb. It's a pretty easy one to understand, right? What about risk reduction? Well, in rock climbing, you use safety equipment, harnesses, ropes, a climbing partner. This allows you to climb, but with significantly less chance of falling, right? Or at least lessening the impact if you do fall. How about risk transfer? This is where we pay someone else to assume the risk for us. And that's what insurance is, right? We pay a regular premium to an insurance company, and in exchange, that company promises to pay the cost of whatever it is that we are insuring against. Whether it's an accident, disability insurance, illness, health insurance, death, life insurance, or being sued, liability insurance. Finally, risk retention. This is when we simply have to assume the risk of whatever it is and realize that if something happens, we have to deal with it on our own. In rock climbing, you can't completely eliminate the risk, even with safety equipment. There's a certain element of danger inherent in that activity. And if you want to rock climb, you have to acknowledge that and be okay with it. These four management strategies can be applied to anything in our life that carries any element of risk, and you have to decide which of them makes the most sense to you for that given level of risk. This chart can be helpful. Let's start at the right lower corner. If the risky thing is unlikely to happen, and if it does happen, it's not going to be very devastating to you, then you should retain the risk and not try to buy insurance for it. This is what I use whenever I'm asked if I want to buy insurance on any of the products that I might buy at a store, like a TV or something like that. I think to myself, what are the odds that this TV is going to be a lemon and not last for the couple of years that I would be insuring it for? And if it does break and I have to buy a new one, how painful is that going to be for me financially? The answer to both of those questions is almost always not a high chance and not super painful. So I retain the risk and don't spend extra money on insuring that product. On the opposite side of that coin, let's think of the risky activity that could happen both with a high frequency and carry a high impact. I don't know, like jumping out of an airplane without a parachute. We're not going to buy insurance for that activity, right? What company would insure you for that? Your best risk management strategy would be to avoid doing that activity or change how you're doing it in a way that reduces your risk, like, I don't know, use a parachute. Okay, so what about risky outcomes that happen a lot but are not super painful physically or financially? Well, again, you probably can't buy insurance for that either because it happens too much for a company to want to assume that risk. So if you need to continue doing that activity, you do your best to reduce the risk of it by altering protocols or adding safety equipment if possible. But beyond that, you just have to acknowledge that you're going to take a hit from time to time. So maybe this is something like petty shoplifting for a store owner, or returns of a faulty or unwanted product for a producer or a supplier. You just have to plan for that inevitability. The final quadrant describes those things that aren't very likely to happen, but if they do, would be devastating financially. Those are insurable, and we can transfer that risk to an insurance company and pay them a premium for that protection. Okay, so the rest of this lecture will be about some of the basic types of insurance. I don't sell insurance and won't even try to touch on all the nuances of the various available insurance products. That'd take a lot of time, and most of you probably aren't interested in a lot of those details from this type of video anyway. So I'm just going to cover the basics here. Maybe in future lectures, we can dive a little deeper into some of the details of what to look for in some of the products that are most important to physicians, such as disability and malpractice insurance. But as an overview, here we go. I think everything on this list should be a consideration for your portfolio. Let's start at the top with health insurance. We all should have a pretty good idea of what health insurance is. We pay a monthly premium to an insurance company who will then pay our medical bills if we get sick or injured. Many or most of us get our health insurance coverage through our employer, although we may pay some or even all of the cost of it. Some of us may need to find it on our own. If you're young and healthy, it's tempting to take your chances and pocket that extra monthly income instead of paying the premium, which can be substantial. Keep in mind that in general, insurance premiums are higher if there's a higher chance that you will have to file a claim. So health insurance, there's a pretty high chance that at some point you'll use it, even if you're perfectly healthy now. You never know when that situation could change for you. Might be a broken arm, a case of appendicitis, or an injury from a car accident. So suddenly you might be facing tens of thousands of dollars in medical expenses and possibly lost income while you're recovering. These things happen all the time to healthy people. What if it's more severe and you get diagnosed with a heart problem or diabetes or even cancer? Now your financial future is in serious jeopardy. It's better to have insurance. That's exactly why we have it. Health insurance comes in all kinds of varieties and options. Many of those are dictated by your employee health plan, but you usually have the choice at least between a higher premium with a lower deductible or a lower premium with a higher deductible. If your deductible is high enough, you may qualify for a health savings account. These are great ways for otherwise young and healthy people to have the advantage of insurance to protect against something catastrophic and an investment opportunity that's triple tax advantage, meaning your contributions are pre-tax, they grow on a tax-deferred basis, and as long as you use the money for a qualified medical expense, you don't pay taxes on it when you use it down the road. There are limits to how much you can stash away each year into these types of accounts, but it's several thousands for an individual and double that for a family. So it can add up, and it's a very useful financial tool. Okay, this is a must-have insurance for doctors and other high-income, high-skill professionals. It's reported that 1 in 4 individuals who are age 20 will experience a disability that lasts at least a year sometime before they retire. Even more will experience a short-term disability associated with loss of ability to work and earn income. Because disability is so common, this type of insurance is relatively expensive. But think about what it does. It protects your most important asset as a doctor, your ability to earn a high income. If you get injured or you're otherwise unable to work, it pays you a portion of your income so that you can still live, pay the bills, and take care of your family. Without it, you could suddenly find yourself in a severe financial crisis. There are different kinds of disability policies, but for doctors, it's especially important that you buy an own occupation policy. That means that if you're injured and can't perform your current occupation and specialty, they'll pay you the benefit, even if you can do something else to earn income, even as a doctor. It's an important way to protect your lifestyle within your chosen field of specialty. There are other things to consider within a disability policy, such as how long until you start collecting the checks after you're disabled, which is the elimination period, how long your insurance will pay you your benefit, usually up to age 65 or 67, the amount of monthly benefit, which you need to be sure is enough to live on comfortably and pay your bills, including saving for your retirement. There are a variety of other riders that I won't go into here, but might give you some extra benefits for a cost. Examples would be like a cost of living adjustment or an inflation rider. The important thing is that you get disability insurance and you keep it until you no longer feel that it would hurt you financially if you lost your income for a period of time, especially if prolonged. Also, you need to secure your own individual disability policy while you're still in residency, when there's guaranteed inclusion. Once you're done training, if you have something that puts you at higher risk for disability, you might not be insurable. It's super important. Okay, so for many of us, our house represents our biggest purchase and most valuable tangible asset. It would be extremely unwise to leave it unprotected, and in fact, it's not even an option if you carry a mortgage on the property. Even relatively minor accidents can result in sizable chunks of money needed to make repairs. Something catastrophic, like a fire or a flood, that could wipe out your property would be devastating financially. Homeowners insurance comes with multiple policy subtypes and forms. I'm not going to go into details of those here, but they cover not just the primary structure, but other structures in your yard, like an outbuilding. It also covers the stuff inside your house and even the cost of a rental if you have to move because of a claim. It also has liability protection if someone gets hurt on your property. Be sure that you understand what perils might be excluded from your policy, maybe fire or flood, for example. You can usually upgrade policies to cover the things that you feel carry a reasonable amount of risk. A subset of homeowners insurance is renter's insurance. If you're renting your home, I would highly recommend this insurance. It covers your personal stuff in case of damage to the place that you are renting or even theft. For example, if a pipe bursts and floods your apartment and destroys all your stuff, a renter's policy will cover you, but the owner's homeowner policy might not. It's usually not super expensive and it's well worth it. Okay, most states actually require auto insurance to be able to drive a car in their state. Car accidents happen all the time, and of course, it's never your fault, right? Well, sometimes, maybe. Regardless, your expensive car just got damaged and may not be repairable, or the repairs are going to cost thousands of dollars. Even worse, if you get injured or injure someone else, the medical cost of the accident can be exorbitant. Or maybe the other driver is not insured and won't pay the bill. And if you are at fault, you are liable for the cost. At the very least, you need Part A insurance that would cover your liability in that situation. Part D coverage is for the damage to the vehicle. There are two kinds, comprehensive and collision. Collision covers the cost in a crash. Comprehensive covers damages if something else hits your car, like a tree falling on it, or a deer jumping out in the road and causing damage when you hit it. Life insurance is another big category, and as the name implies, it pays your beneficiary the face amount on your policy when you die. Do you need it? It's not an automatic yes. The answer is to think about what would happen to your family financially if you were to suddenly die and they could no longer rely on your income. Do you have a lot of debt? You probably need insurance. Are you the sole provider for your spouse and kids? You definitely need insurance. Can your family meet their future goals without you? Think about college, weddings, vacations, all the other things that you had planned for your family with the money you earn. If you're gone, do you want your family to still have those opportunities? If so, and unless your net worth is now high enough that you can fund all those things without your income, then you should get life insurance. What are the options? There are three basic types: term, whole life, and universal. Term is pretty basic and easy to understand. It's really the insurance product only. And like its name implies, you're insured for a specific term, usually 20 or 30 years. It's like renting insurance. As long as you pay the premium every month, you will receive the face value upon your death during the term that it's active. The advantage of term insurance is that it's much cheaper than the other versions. The disadvantage is that it runs out. You can renew it if you outlive your term and you still need insurance, but it becomes considerably more expensive as you age. Whole life insurance is a policy where you pay a fixed premium for your entire life and are guaranteed the face value on your policy. As long as you continue to pay the premiums, your beneficiaries get paid. Plus, some of what you're paying carries a cash value that you may be able to borrow against or cash out at some point in the future. The insurance company invests this money for you in usually very conservative products, and it often comes with relatively high investment charges and fees to the broker. Plus, the premium for whole life insurance is considerably higher than term insurance when you're younger. Universal life is kind of a mix of the two. There's a term life insurance component, which is the pure insurance part, and there's a cash value part like whole life. Universal life is different because you might be able to make some investment decisions yourself with the cash part of it to get some higher returns. Also, if you have enough cash value in the account, you can suspend your premiums for a time without losing your insurance. In general, the investment portion of whole life and universal have higher expenses and lower returns than if invested otherwise, in the stock market, for example. So although there are situations where these types of insurances may make sense, for most, I think term is the way to go, especially if you're disciplined enough to invest the difference in premium cost yourself instead of just spending it. We live in a litigious society, and healthcare providers are often targets of lawsuits related to poor medical outcomes. Sometimes mistakes are made and patients are injured. These judgments can be for millions of dollars. If you have to pay for that out of pocket, it could bankrupt even the wealthiest providers. So malpractice insurance is critical for all healthcare providers. Each state has different laws about how much a physician could be sued for, and usually there are some upper limits, but not in all situations. We all need malpractice insurance to protect our families and our practices. There are a couple of major options. Occurrence-based insurance provides coverage for events that occur during the policy term period, no matter when the claim is filed. Claims-made insurance provides coverage when a claim is filed during the coverage period. The downside of claims-made policies is that when you leave your employer, you may have to pay a tail coverage that would cover you against a claim that is made later for an event that occurred during your coverage term. These can often cost tens of thousands of dollars, so you may need to be prepared for that. When choosing coverage limits, be sure that you're adequately covered based on your specialty and your state tort limits. Finally, there's umbrella liability insurance. We have liability protection built into our homeowner's insurance, our car insurance, and obviously our malpractice insurance. But sometimes that may not be enough and may not cover you in all situations in which someone might choose to sue you. An umbrella policy adds extra protection in such a case. It's worth getting because it's not very expensive to add millions of dollars in liability coverage to your portfolio. Just remember, if someone finds out you're a doctor and assumes you're rich, they might sue you for ridiculous things. Better to be protected. All right, insurance. Kind of painful, but we got through it. Your homework is to review your policies, to consider what you're missing, to speak about options with independent insurance brokers who can compare multiple companies to get the best price. Be sure you have your disability insurance secured before you leave residency. Although insurance is painful to think about and painful to pay for, it's a necessary evil to protect your finances against catastrophe. Thanks for listening. Remember to like and to subscribe to the channel. Help us get the word out. See you next time.